All right, well, I really appreciate you guys, James, having me here today and giving a chance, first of all, to get out from behind my desk doing taxes. I've been working my fingers to the bone during taxes about 14, 16 hours a day, so it's kind of nice to get out and see people smiling. Most of the time, they're not smiling when they come in. They're smiling when they leave, though, because we make it fun. What I wanted to talk to you guys today about how to structure your business so that you can be protected from personal liability and save the most money in taxes that's possible. This is a place where I see a lot of new businesses come in and they wait and they wait and they wait because they think in their head, oh, a corporation, that's something big. I'm not big, I'm just me. And when we go to do their taxes, they owe thousands and thousands of dollars. I did a tax return this morning, and this lady's been in business for 10 years, just doing her own little thing, just by herself out of her home, and she owed $12,000 in self-employment tax. And I said, you're going to love me by the time you leave. And she said, why is that? And I said, well, because I'm going to save you $10,000 next year. That's huge.
That is huge.
And we're going to talk about that and whether or not it's right for you and your business. So go ahead. So when we're talking about incorporating, we're talking about a legal entity. So terminology is a little important. I try to not get hung up on terminology too much because I like to make it easy so that everybody can understand. I'm not a lawyer. I'm not giving you legal advice, but I have been doing this for many, many, many years. So we know what's going on. But the first thing you need to decide is what's important to you. What kind of concerns do you have? Do you have any liability? So Marie was telling me her daughter, she has no liability, right? She has no business, no house, no car, no money, no nothing. So she doesn't really have very much liability. But other people might have a house and a business and a building and cars and trucks and inventory. So those might be a concern for you, your liability. Tax concerns. What tax bracket are you in? Are you married? Are you single? If you're married, does your spouse make a lot of money? Is your business going to put you into a new tax bracket with that household income? What kind of tax concerns? Next thing you would think about is how much control do you want to have over your business? If you want to have total control or do you want to share your control? Next concern would be, what are your capital requirements? So how much does it cost to get a business started? And it probably costs more than you think to get your business started. It's not good enough to just have enough to open the doors. You need to make sure you have enough money to sustain you until you can get enough business to keep things rolling. Just because we build it does not mean they will come, right? And even people, sometimes people are fickle, right? Sometimes people will tell you they're going to do something, then they don't do it, right? They might RSVP and not show up. Right? Okay? So you just never know. And so you need to make sure that you have enough money to keep things rolling. And what are your abilities? You know, maybe you're really good at plumbing. Just because you're a good plumber doesn't mean you know anything about employees or taxes or management or scheduling appointments or auto maintenance. I mean, all the things that are into your business. It may not be something that you know how to do. So those are the main things we're going to address when we're looking at a different type of legal entity. Go ahead. So what are your choices? You've got sole proprietor, LLC, partnership, S-Corp, and C-Corp. And we're just going to go through each of those briefly. And if you guys have questions, just by all means, just speak up. Go ahead. So the first thing would be sole proprietor. Now each of these types of entities has advantages and disadvantages. Some of the advantages of a sole proprietor, one, it's very easy to form. All you have to do is say, hey, I'm going into business, and boom, you're in business. Especially in Colorado, most businesses don't require any kind of license. You don't have to register with the Secretary of State. I could open up a business tomorrow called Debby Miller whatever. Debby Miller golf training, okay? And all I have to do is say that that's who I am, and that's what I do, and I'm a business, all right? So it's super easy to form. Because I don't have to do anything to get it going, it's got low startup costs. I'm taxed at my personal tax rate. Now, I have that on advantages, but that could be a disadvantage, and I also have it on the disadvantage side. If my spouse made $250,000 a year, I wish, and I just started out my little business, and I made $10,000 in my little business, my $10,000 would add to his $250,000, and I'd pay about 39% in tax on my little $10,000. So that's not really an advantage to me, is it? Okay. However, let's take that same scenario. Maybe my husband makes $200,000 and my little business lost $10,000 this year. That's going to flow through, and now we only have to pay tax on $190,000. Then that's an advantage, right? So again, it goes to those. What are your concerns, right? Whether that's an advantage or a disadvantage. Typically, it's an advantage. The other advantage to being taxed at your personal tax rate is you can hire your kids. How many have little kids? 16 and under. You can make your kids do anything that you're able to make them do. And I used to say you can make them do anything. And I had a guy in the class the other day, and he's like, no, I can't make my kids do anything. Well, that's his problem. But as far as the IRS is concerned, you can have your kids work for you, and you can pay them up to $6,100 a year and pay no income tax on that $6,100 for them. It's a tax deduction for you, and there's no Social Security and Medicare. So it's a total win-win. Now, the main thing is they have to be doing something that's worth $6,100 a year. But, if you do a lot of mailers, they can stuff envelopes, they can put labels on. You're not going to be able to pay them $20 an hour to do it, but you could pay them something. So that's an advantage as well. And finally, the final advantage of a sole proprietor is very easy to dissolve. So if you go out of business, you just stop telling people what you do, and you'll go out of business sooner than you think. So.
Tell people what.
Some disadvantages, though. A big disadvantage of a sole proprietor is you have unlimited liability. Now, what does that mean?
What does that mean?
It means, thank you for asking. It means that if somebody was to sue you and you didn't have insurance to cover whatever it was they were suing you for, they can go after your personal assets. So they could take your house, your car, your boat, your 4x4, your dog, your kids. No, they don't want your kids.
Please take my kids.
But this liability is unlimited, and it not only applies to you, but it applies to your spouse. So I've seen people get sued, and not only did they take their personal assets, they attached the wages of the spouse to satisfy the debt. So it can be bad. Now, if you don't do anything to get sued for, you don't have to worry about this, right? So these are things that are concerns that you may or may not have. Another disadvantage is lack of continuity. So if I get sick and I am in a sole proprietor, sole means one, right? If I get sick and I can't work, then I don't have any stability in my company anymore, right? Unless I have other people running it. But if I'm in business all by myself, that's all I've got. So I have a lack of continuity. In this day and age of litigious society, which is one reason why Legal Shield is such a good choice, you have an image of instability, and you could become prey. So if you had a company that made a lot of money, and you were a sole proprietor, meaning you have unlimited liability, and somebody is a bad guy and wants to come after you, haven't you made yourself vulnerable? Okay, so that image of instability is more / vulnerability is what I call it. The biggest disadvantage, I think, of a sole proprietor is self-employment tax. 15.2% on top of your income tax. So go back to that example. I made $10,000. My husband makes $200,000. We're paying income tax at 29% federal, plus 15.2% self-employment tax. So now we're at what? 39.42 plus 5% state. So now I'm at 47%, almost 50% of my $10,000 going to go to the IRS. That stinks. Derek?
Does that sole proprietor tax apply to both incomes?
No, it's just on the profit of the business. Yep. So, but out of my $10,000 profit that I made, how much money am I going to have left? Not much. And what am I going to get to do with it? Nothing. Okay, so that's the big disadvantage if you're making a profit. Now, again, go back to those choices, right? If you're not going to make a profit, who cares about 15%? 15% of zero is zero, all right? If you're not going to make a profit, who cares whether I'm prey? Okay, because there's nothing to get. But depending on what your situation is now, nobody goes in business to lose 10,000 bucks, do they? If they do, you need to send them my way. We'll teach them how to make some money. All right, any questions on sole proprietor? If you have not made a choice, this is what you are, whether you like it or not.
You're probably going to go into this, but if you're in the situation, what you just described, how do you do some business deductions or different things where, yes, you are making some money, but with the business deductions on paper, it looks like you don't have as much profit. Does that work?
Well, if you make money and you don't spend it all, you're going to have a profit.
Yeah.
So there's lots of things you can spend money on to reduce your profit. But if you have any left and you're a sole proprietor, you're going to pay that extra tax.
Okay.
All right? Let's go on. Okay, so the next choice is partnership. Now, partnership is just as bad as a sole proprietor, except now it's multiplied by 2 or more people. It complicates it. Now, how many of you are married? Is everybody here married? Okay. How hard is it to be married? Sometimes it's hard, isn't it? And there's 2 features, and I don't want to get racy here, but there's 2 things that make marriages easier than a partnership. Love and sex, right? Because unless you're having a partner that you're doing that kind of thing with, all right? So those 2 things make it a little easier to be married than to be in a partnership, all right? So in a partnership, theoretically, you got a partner that either had money that you didn't have, had skills that you didn't have, or you're going to combine your skills and do great things together. But typically I see partnerships in, oh, you know what? He's really good at selling window coverings. He's really good with people. That's what you do, right? But I'm not really very good at that. I'm really good at doing the installations. I'm an expert measurer. So we're going to go into partnership together because you're really good at that and I'm really good at this. So those are combining our skills. Now, hopefully you have some money, because I don't have any money. Okay, so neither of us have any money. Maybe we need to bring in a third partner with a bunch of money. And the third partner with the money, we want them to be quiet, because they don't know how to do anything except give us money, so that's good, right? So we're going to have 3 partners in this partnership. It's super easy to form a partnership because, again, all we have to do is say, hey, we're going to all go into business selling window coverings. Sorry. The only difference is now we need to have some sort of an agreement. So it's easy, but a little bit harder. We need some sort of a partnership agreement. Because everybody's happy when everybody's starting out, right? But the only time we have trouble is when somebody gets mad. And then if we have a good, strong partnership agreement, then we can pull that paper out and go, you know, when we loved each other and we liked each other and we were making money, this is what we decided. So this is what we need to stick with. We have total control still of our business, although now we have to share it with our partners. We have hopefully a greater capital pool, even though the 2 of us decided we didn't have any money, so we have one partner with all the capital. But that complicates things, because what if he decides he wants to pull out and he has all the money? The big tax benefit of a partnership is, again, we get to pay tax at our personal tax rate, which may or may not be a benefit. And it may be a benefit for you because maybe you don't make any money, but it's not a benefit for me because my husband makes $200,000. So even though our partnership may be equal, I may end up paying more tax on what I get out of the partnership than you. Disadvantages. Again, now we have unlimited liability still, but now it's multiplied times 3 because we got 3 partners. And not only am I liable for my own actions, but I'm liable for both of my partners' actions. That's bad, isn't it? And if my partners are married, I have to worry about their spouses as well. And if we were to be sued, now all of us are at risk, and everything that all three of us own, and all of our spouses' incomes, everything is at risk. So it can be very dangerous. Now let's take one of our partners away. Now we only have 2 partners left. If we lose another partner, how many people we have left? 1. So now we're not a partnership anymore. Now we're a sole proprietor. So we have to shut down the whole thing and start back up as a partnership. So that's a lack of continuity, and that's a big disadvantage. Again,
Just real quick, sorry, missed it. When you have the partners, you're liable to the other partner's what?
You're liable for the other partner's actions. Right. Let me give you an example of that. I had a couple guys that came in and they were going to do roofing. And the one was just the exact same situation I said. He was really good, and every time he did a sale, he'd take a $5,000 deposit. We had a big hailstorm, and he collected about $250,000 of $5,000 deposits and then split.
Oh.
Now his partner is liable to all of those people to get those roofs done. And he didn't go out of business, but he could have easily. So, and there, the only recourse he has is to go find the guy, kick his butt, right? Or something, do something. Use Legal Shield to find him and sue him. All right. You have a potential for disagreements with a partnership. Anytime you get 2 people together, it's hard, 2 or more people, it's hard to make a decision, right? Have you ever tried to decide where you want to go to dinner? Right? Everybody's got their own idea, or they go, oh, I don't care. You say, well, how about Chinese? Well, I don't want that. Right? So you need to worry about disadvantages or disagreements. And finally, it's hard to transfer ownership. So if you and I are in a partnership together, and we're great friends, we're having tons of fun, we're making money, you decide you want to move to Florida. Oh. So we need to shut the partnership down. But you know what? We've been making money, so you don't want to just walk away.
Right.
And I don't have any money because I spend every penny I get plus. Oh. So how am I going to pay you out for your partnership? Right? So it's really hard to transfer ownership. If we choose another entity, which we're going to talk about, you could sell your ownership in the company to somebody else. But here, in a partnership, you cannot.
Like going through a divorce.
Worse. Yeah. I don't know. I've been married to the same guy since I was 18 years old, so I don't know what that's about. He doesn't make $200,000 a year, though. That's the problem with getting married at 18. You don't know what you're going to be when you grow up, right? Right. All right. All right. Questions on partnerships? Any other questions? Okay. So what's our option now? We don't really want to be a sole proprietor. We don't really want to be a partnership. The next choice up is limited liability company, LLC. It's also called sometimes an LLP, but the LL is the part we're concerned with, limited liability. Advantages to a limited liability: you're still taxed at your personal tax rate, which again we talked about. Could be an advantage, could be a disadvantage. But the big advantage is now our liability is limited to what the company owns. So they can't get my house or my boat or my car or my kids or my dog unless I got greedy and put my house and my car and my boat in my company so that I could write them off or something, right? So you have to use a good accountant who can help you to manage your risk, all right? But technically, you're only liable for what the company owns. Disadvantages: they're not recognized in all states. Now, that probably isn't going to affect most of you, but my clients who are over-the-road truck drivers, they might have a limited liability company, and if they get in an accident in Colorado, the only thing they can get is the truck. But if they're in Oklahoma and they get in an accident, all of a sudden, all of their assets are at risk because Oklahoma doesn't recognize a limited liability company. It's also not recognized by the IRS. So if you came in and said, Debbie, I'm an LLC and I want you to file my tax return, I would say, are you a single member LLC? And if you say yes, then I would tell you have to file a Schedule C, which is on your personal taxes. If you have more than one person, then we would have you file a 1065, a partnership tax return. So the IRS doesn't have an LLC tax return. They don't see limited liability ever. Okay? New members require unanimous consent. So the two of us are in a partnership, but we need somebody with more money. So we want to bring on a third partner, but you don't like him. We can't do it. It has to have unanimous consent of everybody involved to bring in a new member. And then that self-employment tax, that dreaded 15.2%.
Is that the payroll tax? Or
It's called payroll tax or self-employment. It covers Social
you pay the
Security and
whole
Medicare.
amount instead of half when you're self-employed.
Exactly. Yeah, so what he was saying is when you're working for somebody else in a job, you always see that on your paycheck, right? Social Security and Medicare, you pay half and your employer pays half.
Right.
But when you're self-employed, you pay both halves. Okay? Questions on limited liability? Okay. How are we doing on time?
We're at 19 minutes.
19 minutes. Okay. S-Corp, this is the next step up. Oh,
I may be jumping way ahead, but is there any way to get around that self-employment tax?
No way to get around the self-employment tax with an LLC or sole proprietor or partnership. But we're getting there. I have a secret in my hip pocket, although I have no pockets today, which is why I'm holding this.
So, Debbie, so I didn't realize that is the 15.2, that equals the employee-employer portions put together. So when you're on your own, you're doing that.
Right.
Where otherwise it's roughly 8 and 8 or so.
7.65 or something like that, yeah. Okay, so an S corporation, that's your next option, all right? When you go and set up your company, you become automatically, once you set up a company, you automatically become a corporation. If you set that up, you have to ask the IRS permission to be an S-Corp. So it's an election that's made after the fact. The advantage of being an S-Corp is, again, you're still taxed at your personal tax rate. So we have all that flexibility that we had with all those other ones. You still have limited liability, so that's a good deal. Now, though, it's easier to transfer ownership. So if you and I are in a business together and you don't want to be anymore, you could sell your share to somebody else. And I don't care or have a choice, really. You have continuity. This is a separate, separate legal entity. It survives you because you are not it. It is its own it. Right? So Phases Accounting and Tax Service is going to outlive Debby Miller until somebody stops running the business, and then it'll go out of business. But it'll still stay out there until somebody shuts it down. Okay? It may not have any money, may go into debt, but it'll still be there until somebody physically shuts it down. No self-employment tax. So this is the answer to your question. If you're an S corporation and you make a profit, you don't have to pay self-employment tax on that profit. That's a good deal. Now, the IRS wants you to take a salary. They're not going to let you get out of it scot-free. But you have some flexibility. You have some control over that. With the LLC, sole proprietor, and partnership, you pay self-employment tax on 100% of your profit.
So is this where then you would have to issue yourself a W-2 from the S-Corp? Is that how that works?
Yes. Okay. Yeah. In order to take some wages and get some self-employment tax and stay out of the IRS hair, you're going to need to take some wages. And that's where you would pay your self-employment tax. But the point is that it's in your control. Yeah. The other ones, you have no control. You have to pay it on all of it. Disadvantage of an S-Corp is we're taxed on all of the income at our personal tax rate. So a lot of times we start up a business, it's doing great. My husband makes enough money to pay my personal bills, so I don't need to take money out of my company. Why should I have to pay tax on it? I'm leaving it in the company. Well, you have to pay tax on it whether you take it out of the company or not. So once you've paid tax on it, you might as well take it out because it's yours and you've paid on it. There are higher startup costs on an S corporation. You have to pay to incorporate. You need to have annual meetings. You have to have a separate tax return done. You should be doing some payroll. You need to run it like a business. All of those things are going to cost you money in some way.
Do you have an idea what those typical fees are?
The typical fee, what phases, we charge $550 right now to set up an S corporation or a C corp. Corporate taxes are going to run you anywhere from $500 to $1,500, depending on who you are and what you do and how much money you make. Payroll's going to run you probably, I don't know, $150 to $500, depending on how many employees you have. So, but all of the things that you pay for, and those are all business expenses. So, it's all a part of saving money. You have extensive record keeping. So all of those other business entities, we could just keep a checkbook if we wanted to. There's no law that says I have to have QuickBooks. I have to do financial statements. Now, I can tell you I've been doing this since 1987. If you manage your business by checkbook balance, you're never going to make any money because there's never enough, is there? There's always more month at the end of your paycheck. So you need to make sure that you're running your business like a business. And at S corporation, the other disadvantage is that you have to have a calendar year as your tax year. You can't choose a year of June to July. All right?
You have to start up in January.
It doesn't have to start in January, but your year has to go from January through December. So it's a calendar year requirement.
So if you start in April, it's April to December, the first year.
Yep. Questions on that? I'm just kind of glossing over everything because I can teach this class all day long.
Debbie, in the S-Corp also, isn't there more protection on the liability side?
Liability is exactly the same with an LLC as it is with the S-Corp. Yep, the liability protection is the same. C corporation is the last choice. Now, a C corporation has specific advantages and disadvantages that are different from all of the other ones. All of the other ones we talked about pay tax at your personal tax rate, right? Those are all called flow-through entities. So that means the profit or loss flows through onto your personal taxes and melds with everything else on your personal tax return, okay? C corporation does not. C corporation is completely separate, pays tax at its own tax rate, and it's not as flexible. It's harder to get money out of it to put into your personal without paying tax. However, you still have limited liability, which is great. You still have ease of ownership transfer, which is great. It still continues well after you're gone, which is great. The best thing about a C corporation is it starts at 15%. So the first $50,000 that you earn in your C corporation is taxed at 15%. Now, if you are married to somebody who makes $200,000, that's huge, right? Because before, what were we at? We were at, what, 47.5%? Now we're at 15%, okay? So depending on your situation, not everybody's the same, we may suggest to you that in your business that's going to make $10,000 a year, that you don't ever have to pull money out because your husband's paying all the bills, maybe we would choose a C corporation for that business. So there's no plain vanilla answer to each person's situation. C corporation, again, you have high startup costs. They're relatively the same as they are with an S corporation. The big disadvantage to a C corp is double tax. Double taxation. So when you make a profit, you pay your tax on that profit. If you pull that profit out of your business to use personally, then it's income for you personally and you have to pay tax on it again. Okay? So this isn't the right situation for everybody, and that's why we talked about what are your tax concerns, so that we can help you pick the thing that's right for you. It's very easy to start as a C corporation and change down to a S corp or something like that. It's easy to go from an S corporation to a C corp, but you can't keep going flip-flopping back and forth. All right? And you have extensive record keeping with a C corp. The IRS is very specific on a C corp. You cannot commingle funds, meaning you can't use your business checkbook as your personal checkbook. They don't really want you to do it at all with any kind of business. But we can probably get by explaining things out a little easier with an S-Corp or an LLC than we could with a C. All right? So, C-Corp, Schedule C, that's the sole proprietor limited liability. That's going to keep things simple for you. If you want
to file taxes,
pardon me?
when you file taxes, you use a Schedule C?
On a sole proprietor limited liability, single member limited liability, you do a Schedule C. So that keeps things simple. So if you want to keep things simple, that's your choice. If you want to pay the least amount of taxes, let's do a C corporation, because I can set things up in a way that you're going to pay the smallest amount of tax possible, but it is not flexible. If you want flexibility and you're kind of flip-flopping around, just starting out, not sure where you're going, an S corporation is a very flexible choice, and it's a good choice, and it also helps you to avoid that double taxation. So that's just kind of like a rule of thumb of those things. So what do you do now? First thing is, don't guess. Okay? Don't guess.
Oh.
Don't take your tax advice from your hairdresser.
Right.
Don't take it from your brother-in-law, okay, unless your brother-in-law is an attorney or me. Let's look at what your particular situation is now, what you want it to be, and let's make the right choice. All right? We can give you a free consultation, no obligation, no strings attached.